A potential fiscal cliff looming. Congress is facing multiple deadlines. In the next week, lawmakers will have to address the debt ceiling, pass a measure to fund the government beyond next Thursday. Senate Minority Leader Mitch McConnell has made it clear it is up to the Democrats to make both happen as they continue on their spending spree. Joining me right now is the Bear Traps Report founder and editor, Larry McDonald. Larry, it's great to see you. Thanks very much for being here. How are markets viewing this 6 legislative days left to make all of these decisions? You say if a deal is not made on the Hill, a fiscal cliff could force stocks to lose 20% by year end. Explain.
Yeah, there's a huge divergence in the market, Maria, because we're at all-time highs. And people have to realize we've done $6.5 trillion of deficit spending the last 2 years, $6.5 trillion. And Republicans and conservative Democrats want to take that down to 1 or 2 trillion. In other words, this year the deficit, last year the deficit was 3 trillion total, 3.5. They want to take it down to 1. That's a $2 to $2.5 trillion fiscal cliff, and the equity market is not priced for that. So we have a lot of drama coming the next 6 weeks as Republicans and Democrats fight this out.
Yeah, we're also watching corporate earnings. Profit margin pressures continue to mount on some companies. FedEx, for example, cut its outlook for profits after missing analyst estimates. It blamed a tight labor market, higher costs, stalled growth in shipments. Shares of FedEx plunging 9% on the news yesterday, Larry. What do you say in terms of that story and what this means for other companies? Are we seeing a profit margin squeeze here as we get into the earnings season?
Maria, I mean, I've been in this business for close to 35 years. I've never seen the market so offsides on earnings because the street lowballed the earnings into Q1, Q2. We had a surprise, and then the entire street raised up earnings dramatically. Now we're seeing tremendous pricing pressure from inflation. Let me give you an example. Household durables inside the University of Michigan. So if you look inside the University of Michigan consumer data, was the worst bad buying conditions since the 80s. So you're talking about the worst bad buying conditions. And our data shows, if you look back historically, if you look at the relationship between how the consumer feels and how CFOs feel, that pricing pressure is going to hit profit margins dramatically. The FedEx news is just like basically a warm-up. And so I recommend, we're seeing maybe a 20, 30% move down in stocks here the next 2 months, 3 months. So take down risk. You've had a good year in profits. It's time to manage risk properly.
Yeah, I want to ask you about managing the risk around China, because China is asking local governments to prepare for the downfall of Evergrande, meaning the CCP has no plans of bailing out the second largest property developer in the world, $300 billion in liabilities. The order being compared to getting ready for a storm coming. It comes as Evergrande's second largest shareholder announced plans to sell the entire stake, Larry. What's your take now, a couple of days after this news first broke, in terms of the potential for contagion here?
Well, 13 years ago, I did my first television interview with you after Lehman failed, and our book's now in 12 languages. A Colossal Failure of Common Sense is the title, and I see a lot of this in China. The difference is, you think about Evergrande is about 300 billion in size. Lehman was a little bit more than 620 billion. So they're both gargantuan defaults. I think the difference is Hank Paulson and his team at Treasury, they really needed Lehman to fail. They wanted to pass the TARP plan, which is a big relief plan after the financial crisis. So they took Lehman Brothers' head, they put it underwater, and they watched for the bubbles. Whereas China has Olympic Games coming up in February. Then they have the Party Congress next year, where President Xi does his dog and pony show in front of party leadership. So I sense they want to do a controlled unwind here, what's called a forbearance deal. Typically, what we saw in Greece, very similar, where Greece was a $200 billion failure. They lowered the coupons and they extended the maturities. And so instead of letting the business cycle cleanse things very quickly, they'd rather do it over an extended period of time.
Yeah, it's interesting to me that Evergrande's stock rally 17% overnight as the CCP tells local governments to prepare for the downfall.
Yeah, well, it's a little bit of a relief rally in the sense that, Maria, we have our index of our 21 Lehman systemic risk indicators, and they've been making noise through the year, especially with U.S. equities. But if you look at the credit spreads of banks in the Asia region that are exposed to Evergrande, they're relatively tame. And if you look at the volatility on the yuan or the Chinese currency, the renminbi, CNH, whatever you want to call it, the volatility, just look at the currency itself. The currency's been strong all year. It's weakened a little bit, but it's before the 2015 devaluation crisis, Maria, in China, that was a big deal, 2015-16, the currency was a lot weaker. So it's just very strange that around Evergrande, we do have a big piece of risk, but it doesn't seem to be moving outside the shores of China.
Yeah, well, China cannot allow all of the property developers to fail. That will certainly take down its economy. And Larry, by the way, I remember our first interview 12 years ago very well. That was such an incredible moment in time when Lehman Brothers failed. I'm so happy that we are still talking and living this incredible moment in time again. Larry, good to see you. Thanks very much.